Hello and welcome to the July 21st, 2023 episode of Watching the Tape. Bonds have been pretty interesting for a while now because interest rates are obviously a lot higher than they were a couple years ago. So I've had many discussions with clients about how to take advantage of these higher yields. And on a few occasions, clients have specifically asked about tax-free municipal bonds. Now, I did cover municipal bonds in a video last year, but I think it's definitely worth revisiting. As you probably know, interest earned on tax-free munis is not subject to federal income taxes, whereas interest earned on corporate and government bonds is taxed as ordinary income, meaning you'd pay taxes on that income at a rate that corresponds to your marginal tax bracket. So it stands to reason that if you are comparing the yields on two bonds, and one is tax-free and one is taxable, you should make sure that you're comparing apples to apples. And you can do that by adjusting the tax-free municipal bond yield to a tax equivalent yield using this formula. You take the municipal bond yield and divide it by 1 minus the marginal tax rate. So let's use some real numbers here. So let's say the muni bond is yielding 2.6% and the marginal tax rate is 35%. So 2.6% divided by 0.65 equals 4%. And 4% is your tax equivalent yield to compare to yields on taxable bonds. Let's apply this formula to what's happening in the real world right now. We'll compare what a high quality tax-free muni is yielding on a tax equivalent basis to the yield on US Treasuries. So the yield on a 5-year AAA tax-free muni is actually 2.6% today. And the yield on the 5-year US Treasury is 4%. We have a table here to help illustrate this comparison. We'll start with the taxable US Treasury, which yields 4%. And then one by one, we'll add the tax equivalent yield of that 2.6% muni for each marginal tax bracket, starting with the lowest tax bracket. So in that 10% tax bracket, the tax equivalent yield is 2.89%. So if you were in that 10% tax bracket, you would obviously opt for the taxable US Treasury at 4%. And that preference for the taxable bond holds as we march our way through the individual tax brackets all the way until the 35% tax bracket, at which point it's really a push. You could consider that the break even between the taxable and the tax-free bond option. Beyond that, it makes sense, at least on a yield basis, to select the tax-free muni. And I even added a 40.8% tax bracket, which is the highest marginal tax bracket of 37% plus the net investment income tax of 3.8%. The takeaway here is that while the tax-free feature of munis certainly gets people's attention, they really only make sense for investors in the highest marginal tax brackets. Right now, at least, that's not always the case. All right, let's go back to that 2.6% yield on the 5-year muni. 2.6% is 65% of the yield on the 5-year US Treasury, which is taxable. Recall that yield is 4%. That ratio of 65% is followed very closely. And in fact, Bloomberg tracks this information daily. Here is a chart of that ratio going back 1 year. And indeed, it is at 65% today. But last fall, the 5-year muni yielded 80% of the 5-year Treasury. So the bond math was a bit different back then. Instead of a tax equivalent yield chart that looks like this, in which the break-even was at the 35% tax bracket, it would have looked more like this chart, where the break-even would have been at the 22% tax bracket. So in other words, munis would have made sense for a heck of a lot more people back then. I will wrap up with some closing comments. First, I purposely kept this video simple by only comparing yields. Obviously, you'd want to consider credit risk and duration before making any investment decisions. Second, our yield comparison is most relevant for clients in Washington, Florida, and Texas because those states don't have income taxes. Oregon, California, and Arizona clients would want to factor in state income tax rates in their calculations. Third, and this is something that doesn't get mentioned very often, is that your tax bracket can change year to year. So you may be in the highest tax bracket this year, but if you expect to fall into lower tax brackets in future years, then that would reduce the attractiveness of tax-free munis. Fourth and last, if you are not a client of ours and your broker tries to sell individual municipal bonds to you, just say no. These trades make a lot of money for brokers, but they leave investors with bonds that are difficult to sell at good prices in the event they have to sell them before maturity. If ever there is a time when munis make sense for you, then it's much more likely that an ETF or a mutual fund of municipal bonds is your best bet. That's it for this week. If you found this video helpful or interesting and can think of anyone else who might benefit from the content, please share it. Thanks for watching. We'll see you in 3 weeks.